The most obvious, of course, is commodity prices and specifically the oil price. It's not so much the actual level of the oil price, but the investor sentiment towards emerging markets that has hit record levels with it, record low levels with it. We don't need that much, we just need a stabilization of the commodity market to get us out of this spiral of negativity. And that will allow investors to focus on fundamentals again and to realize that the positive returns are actually possible in a low oil environment. In such a scenario, I expect positive returns for Russian fixed income markets. Well, a year ago, Russian credit was a high beta, high conviction story. Today, it's more of an attractive carry play. Why is that? That's because compared to other emerging markets, Russia was actually an early mover. This is also because of the political dispute with the West that forced Russia to face the necessary adjustments early on, well before other commodity exporters had the need to do so. And that's now reflected in the prices. Also on a macro level, corporates were proactive. We saw bond buybacks, we saw balance sheet, not restructurings, improvements, balance sheet improvements, and that's reflected in the price. So from a relative value perspective, I see better opportunities elsewhere, such as Kazakhstan, Azerbaijan. These guys are behind doing the necessary adjustments to their macro environment. And I also see better value in markets like Mexico or even Brazil to some extent. Nevertheless, Russia has proven to be a very reliable, attractive creditor in a stress scenario, and it's still an overweight in our portfolio. Russian credit already has stabilized. The ruble will continue to trade with oil, which I expect to remain volatile. I don't see much of an impact or any impact at all. The key question for the oil price for me is shale gas producers in the US. And once we see production cuts from them, we will have an impact on the oil price. I don't think the Russian-Saudi agreement will do that.